So the Federal Reserve on Wednesday provided the clearest hint yet that it could start raising interest rates in March as a way to try and control inflation. Joining us to talk more about that is local financial advisor Bruce Allen of Bruce G. Allen Investments. Bruce, good morning.
Good morning, Gary.
So talk about the Fed meeting yesterday. What happened?
Well, Jerome Powell came out with both arms swinging. One, we're going to see significant rate hikes. Previously, the best guess on Wall Street was we're going to see 3 hikes, maybe 4. Now, after his comments yesterday, many participants are looking at 5 rate hikes. So instead of raising rates 0.75%, we're now looking at rates going up 1.25% in 2022. So the speed with which these rate hikes is going to happen more quickly. Secondly, is there are hints now that the Federal Reserve will pull back not only on stopping their bond buying, but actually start reducing their balance sheet or selling bonds back into the marketplace. That's the concern that the markets are absorbing right now.
So how will these higher interest rates affect you and I?
I think there's a couple things. One is that we are likely to see higher interest rates. So while short-term rates are rising, that's also pushing up longer-term interest rates. And many mortgages, car loans, things of that nature are based on the price, the yield of the 10-year Treasury bond and longer-term Treasury bonds. Those set the interest rates for mortgages and car loans. And we may see higher interest rates on mortgages, car loans, and other kinds of debt as we go forward, as the interest rates across the spectrum go up, not just short-term rates, but long-term rates as well, Gary.
So I guess the idea is that if we do enough of these interest rates, it will balance out because inflation will fall, right? That's the idea?
Yeah, the hope is that Federal Reserve Chairman Jerome Powell will try to cool off the economic growth, which has been extremely robust in the last 18 months. We've seen a tremendous economic rebound out of the COVID crisis. And what he's concerned about is how do we try to get inflation back down around 2%. Inflation at the end of the year, Gary, as you know, was running at around 7%. So he's got a way to go. So he's moving fairly quickly to try and contain this, the inflation dragon, as you will.
All right. And so finally, how is all of this going to affect the markets? It's been a crazy week on the stock market, I know.
It has been. And if you look at year to date, you're seeing sectors performing differently. Those sectors that do well in an inflationary environment are up significantly this year. So what you're seeing, for example, is energy stocks are up over 20% so far in 2022, whereas stocks that are sensitive to interest rates rising, like consumer discretionary and information technology, are down over 10%. So we're seeing very disparate action in the stock market as the market absorbs this new information and this new climate that we're in, and the markets, the participants in the market are adjusting their portfolios to make sure that they can take advantage of higher inflation and these higher interest rates.
It's going to be an interesting ride the next few months. All right. Bruce Allen, as always, it's good to see you. Thank you.
You as well.